Hello and welcome to this video. I've got Alan Hibbard with me once again. Alan, how are you doing?
I'm great, Mike. Thanks. How are you?
Good. So, you've let me know that there is a question that you've been asked, that people are asking, and I already know what the question is, so I prepared a little presentation. Do you want to tell people about what's going on and the question that people have been asking?
Yeah, people have started to notice what's going on in the banking sector, particularly with New York Community Bank and its plummeting stock price and all of the controversy surrounding it. And we put together a dedicated URL for all of our viewers that they can go to and stay up to date on all the latest tweets, articles, videos, anything that we can find that's related to the banking crisis. And the thing that people keep asking is, why isn't Mike making a video on this? What does he think?
Well, it's interesting to read that it's seemingly starting to spread because an article that I read about it said that Deutsche Bank may be affected, and that is a big systemic bank. But anyway, I've been the reason I haven't said anything yet is pretty simple. It's because I have said something. I've been saying something for over a year now. It just didn't have the name New York Community Bank on it. I've been saying that this was inevitable, that this had to happen. And, back after the Silicon Valley Bank, I pointed out that in April of 2007, New Century Financial filed for bankruptcy. And then 5 months later, there were bank runs at England's Northern Rock. And then 6 months after that was Bear Stearns collapsing. So you've got these time lags that happen with these cracks, but that still wasn't the biggie. Then 4 months after that, Mack and Countrywide Financial collapse. So that started the ball really rolling. Bear Stearns and Mack and Countrywide started the ball really rolling in the U.S. And then 2 months later, 2008, Fannie Mae and Freddie Mac are nationalized. Now, I'm going to stop here and ask you what you think about all of this and what you, in that last one, Fannie Mae and Freddie Mac, have you got any idea of what the side effects of that are?
Well, anytime the government nationalizes anything, it just kind of delays any problem because they have no risk, essentially, or they perceive that they have no risk. But obviously, you can't just kick the can forever. So I would think that this would delay problems and exacerbate them so that an eventual crash is ultimately even bigger.
Yeah, I just find it interesting that there's these, they paper over something and there's a pause. They delay it. Paper over it, another pause. But when it comes to Fannie Mae and Freddie Mac, Ben Bernanke gave that speech, Deflation, making sure it doesn't happen here, back in 2002. And in it, he laid out all of these different things that he said that the Federal Reserve can expand their menu of assets they purchase, like they're sitting in a restaurant. Well, the Federal Reserve Act limits them to only being able to purchase securities that are guaranteed by the U.S. government as to the principal and the interest. So it has to be guaranteed by the taxpayer. By nationalizing Fannie Mae and Freddie Mac, all of the mortgage-backed securities that they had created, Fannie Mae and Freddie Mac, which is the vast majority of all mortgage-backed securities, are the ones these agencies were involved with were then eligible for the Federal Reserve to purchase through open market operations. Before that, they weren't. Now, I find it interesting that this happened before QE, that this was like just before the whole thing is going to unravel and fall apart. This item was placed on the menu like a special for Ben Bernanke. You go into a restaurant, do you have any specials? Yes, we've got mortgage-backed securities. It's delicious. Try it. 1 week later, Lehman Brothers, the largest bankruptcy in history. And this is where it all starts. But the point is, we've just experienced Silicon Valley, Signature, Silvergate. I can't remember the others. But anyway, one day after that, AIG gets bailed out. 9 days after that, Washington Mutual. That was the largest bankruptcy of a bank, largest bank failure in history. And, you know, the papering that they did in March and April, you know, I was at dinner last night, actually, with a couple of colleagues, newsletter writers and people, you know, in this industry that either write about investments or they have an investment service. They manage capital. And they were saying, you know, well, they were able to, you know, we're waiting for like this whole thing to fall apart. And it doesn't necessarily have to fall apart. If you remember, gold was about 1,000. It fell down to 700 during the crisis in 2008. And then it went from 700 to 1,900. And now it's at 2,000. You know, I will take that same percentage move again, and they can paper over it again. But even though the whole financial system did not collapse, it wasn't Bernanke-geddon necessarily, but I do believe that we're in for we're going to experience global financial crisis 2024. If not 2024, it's going to be 2025. But I really think that we are in for something big. And because of the scale of the bubbles that we are in right now, they are bigger than they were back in 2007 when the 2008 crisis started, basically. Because of the scale of these bubbles and because of all of the previous interventions and warping and twisting of the economy, that it's actually going to be worse and require a far greater percent. And I wrote about this in my update to my first book in 2015, where I outlined how the government, whenever I call it the FOG, the financialization of government, FOG, financialization of government. Whenever the stock market goes down now, so does government income. Tax revenues fall. And so when you have a big crisis like 2008, you not only see deficit spending expand, but then it becomes even worse as they plan on deficit spending by passing these huge budgets, these spending bills to try and save us. But at the same time, tax revenues are falling. So they're digging a hole deeper, but they're digging a hole in quicksand. And it's just getting deeper and deeper and deeper. So Washington Mutual, a month later, now the crisis of 2008 is starting to end, and you're not seeing like 2 months, 1 week, 1 day, 9 days. It's back to 1 month. Citigroup bailout, General Motors and Chrysler bailed out, Bank of America bailed out. And so have you got any comments on all of that?
Well, I think for the most part, thematically, I agree with you. I just think it would be interesting to overlay that timeline with some of the quotes from Bernanke or, you know, different presidents or politicians saying, "Oh, subprime is contained." You know, 1 week later, this, or you know, and so forth. It would be really interesting to overlay those quotes if you ever get around to updating it.
Yeah, I mean, I think it was less than a month before Lehman or something like that he said subprime will not affect the regular economy, the main economy. You know, this presentation that I'm showing you, I made a version of this for first right after the Silicon Valley Bank failure. And then I updated it and made it a little bit more powerful for a Wealthion presentation, and then updated it again to this one that you're seeing here. That was my I recorded it originally on Thanksgiving Day, and it was the emergency market emergency video that was from Thanksgiving. And I was warning everybody about this. And then Todd Sachs, who runs a real estate channel, YouTube channel, interviewed me. And what's interesting is, you know, I've been saying stuff that's very anti-government and anti-Federal Reserve for a long time. And I've been feeling that our channel is getting throttled, that it isn't, you know, it's basically shadow banning when they limit the amount of recommendations on that sidebar and stuff. So it's a form of censorship is what it is. But I went over all of this with Todd Sachs, And so that on our channel, it's got like 80,000 views, and on his channel, it's got 600,000 views. Same presentation. And for him, it was done like 2 months after I was giving this warning on Thanksgiving that people need to get ready for this. Now, if we have the same scale move, I mean, it went from 700 to over 1900. So, you know, well, more than a doubling. And we're at 2,000 now. So you're talking $4,000 or $5,000 gold. I will take that, even if they're able to paper over this thing, because the only way they can paper over it is with massive, massive currency creation. But I pointed out the size of the failure. Well, you can't really see my cursor on this, sorry. But if you look at the center of these circles, you'll see that the first big thing on here that shows up, IndyMac Bank, the center of that circle is quite a bit before Washington Mutual. And Lehman Brothers doesn't show up on here. It would fill the entire chart from top to bottom or more. But then you look at the size, you know, there was IndyMac and all of these other little bubbles that were starting to burst before that very center on the timeline of Washington Mutual. So there were quite a bit of bank failures and emergencies happening that were warning signs. And look at what our first warning signs have been in 2023. Signature, Silicon Valley, First Republic isn't on this one for some, because this chart was made before the First Republic was merged or bailed out, whatever happened there, I can't remember. And there was a shotgun wedding for Credit Suisse with UBS. And I was going to call it USB, UBS. If that hadn't happened, the entire, you know, that was a systemically important bank to where the entire financial system would have frozen up if Credit Suisse went under. But it was at risk of that happening. And this is, I said then, this is only the beginning. These things. Do you remember how hard you and I were working to try and get the book out, because we knew that this crisis that happened March and April of 2023, we knew that was going to happen. You and me, we were absolutely positive, and we were rushing to try and get the book out and onto Amazon before this thing actually broke loose. It's just like, I know, you know, people say, well, why aren't you commenting on New York Bank, New York Community Bank? And it's because I have been for more than a year. Yeah. We started with the crazy rate of change of the Fed changing interest rates. And so when you look at, and this is fairly old as well. Hi, I just wanted to take a moment and thank you for subscribing, and mention that if you'd like to help our channel, please consider my company, GoldSilver.com, the next time you buy precious metals. We're one of the most trusted names in the industry. Our prices are sharp, delivery is fast, and we have an insiders program where you find out exactly what I'm doing with my own investments. Thanks for making GoldSilver.com your dealer, and now back to the video. But when you're, because they estimated 2023 is estimated in here, but unrealized losses on lenders' balance sheets in billions, and you've got held to maturity, so they don't have to disclose the stuff in red. They're saying this is going to be held to maturity, but somebody calculated all of the bonds and notes that they're saying the bills, most of those are available for sale. If it's a 3-month bond or whatever, that's the backbone of the banking system. Any comments on this, the danger that's involved here?
Well, yeah, it's massive, and it's got to show up somewhere. And based on the type of analysis that you and I do, when we look at the sort of macro picture, it's very hard for us to come up with a specific name like a New York Community Bank, because we don't go into the weeds. We're not specifically banking experts. You know, we analyze the economy more broadly. So, I mean, we can say like, okay, there's going to be a banking crisis, and it's basically a coin flip from our perspective, or a roll of the dice. Who's going to be first? What's the name going to be? But we know it's coming. So yeah, it's just hurry up and wait, I guess.
from my perspective, I think that anybody that isn't holding precious metals right now is putting themselves at tremendous risk. And I think they're just absolutely, I mean, it's an insane thing not to hold the primary asset of the foundation, I should say, of all central banks' assets. You know, it's a tier one asset now, gold. And countries that don't have enough gold have been accumulating gold in their central banks, with the exception of like Canada and stuff. But all of the Eastern countries know there's something coming. And these are like the shots across the bow, the cracks in the foundation. And people need to pay attention to what's going on and protect themselves. And so, you know, you said that this doesn't have any particular name on it. Well, this, that was 2008, by the way. So look at the exposure we had back then, almost nothing. And they were all listed as available for sale. They weren't being kept secret to make their balance sheets look better. If you mark it as held to maturity, your balance sheet is going to look better than if you mark it to market, what you could sell it for today. If there was an emergency and you needed those funds because you had a bunch of customers withdrawing cash from your bank, and you need to raise some capital, then you've got to sell these bonds. And if they're forced to sell the ones that are marked held to maturity, then they have to mark them to market. So all of that, the red on here that is a lie on their balance sheet, that they're saying, well, it's worth full face value. Well, it's not. And then, but in the next one, we do have the 4 big banks' unrealized losses. Now, I do have to, you know, as all of these things unfold, we all learn more and more and more. And the smaller banks have a higher exposure to the commercial real estate problem. The smaller banks have a much higher exposure. Really big banks have like a 6, 7, 10% exposure. Small banks can have 20, 25, 30% exposure. And so what you're going to see is a whole bunch of these small banks, and we've been seeing this now ever since the Federal Reserve was established. You know, it was passed in 1913, but it was November of 1914 when they opened their doors. And ever since then, we've been seeing this consolidation to where there's fewer and fewer and fewer banks available, which means there's fewer experiments going on, free market experiments in banking, and there are fewer choices for all of us. But if you look at the scale, the red one, which is Bank of America, which I bank at, I've one of the banks that I bank at is Bank of America. It's got the largest exposure to these unrealized losses of bills, bonds, and notes being marked to market instead of being held to maturity is the way they're keeping them on their balance sheet versus marking them to market. And that is a very dangerous thing. And, you know, in chapter 6, I think it is, of Great Gold and Silver Rush, we come across the point of no return. This is an album cover from a Frank Sinatra album that I like. But this is the point of no return, is the return, or should I say lack thereof. It's return on investment. You made this chart. You came up with a great but technical explanation, and I put it all in the book. And I said to the readers, it's okay if you don't understand that. It means, you know, Alan has this right. But explain this chart for us, because you made it.
Yeah, absolutely. So what we're looking at here, the blue line, the squiggly blue line, is the 5-year change in GDP divided by the 5-year change in gross federal debt. So we could ask ourselves, okay, if the federal government takes on more debt, if they take on $1 of debt and it leads to $2 in GDP growth, then arguably that might have been a good investment, arguably, right?
Yeah,
but if the government
cash flow real estate or something, yes.
Yeah,
right.
There's a way. If it spends $1 on some public service and then people derive tremendous benefit from it and end up creating value and paying more in taxes and so forth, it could make sense. But if you get to a point where you're taking on $1 of debt as a country, right? The federal government takes on $1 of debt and you only get 50 cents worth of GDP or 10 cents worth of GDP, it's definitely a bad idea and you should stop immediately. Like there's pretty much no argument about it. So what we see here, this downward trajectory, is that initially every dollar of debt was yielding over $7 in GDP growth, which is pretty impressive. And that trend has dropped until about, looks like 2008 approximately is when that blue line crosses below the red line. And we're in
the inception of Bernankenomics.
Yeah, and that's when we're in that downward spiral that, I mean, you really got to take action and get out of that immediately, because every additional dollar of debt is producing less than $1 of GDP growth. It's a really bad investment. It's a divestment. You're sort of choosing to dig a hole. So you got to stop immediately, and it doesn't look like we're stopping.
Our government what this says to me is in 2008, we passed the point of no return. And what the government is doing, especially with this insane spending bill and stuff, the politicians still think that we're in the good old days back in the 60s, 70s, 80s, 90s, when we could borrow our way to prosperity. But now all we can do is dig the pit deeper, and this pit is going to be digging our own grave. That is the problem with Bernankenomics. And it's going to lead to Bernankegeddon, which I think is something that lies right around the corner. And if they are successful, if people go, oh yeah, but they'll fix it again. I expected it to happen in 2008, but they'll fix it again. And that's sort of what I heard last night. But my response is, yeah, but if gold went from 700 to 2000, I'm still fine with that. And so I really do think that, if gold goes from 2,000 to 4,000 or 5,000, I'm fine with that too. And that would be the result of them trying to fix this. And you do have to look at when they started QE, this line was still positive. It hadn't turned negative yet. And it's the result of QE and the levels of debt that we have that have caused this. Any closing words?
Well, yeah, I mean, yeah, I guess I don't need to belabor the chart here. We've kind of gone over that, but like when you and I look at these long-term trends, we see all these things that are sort of, I don't know, irrefutable. Like I haven't heard good arguments against it. It's just inevitable that these crises are going to happen. And I'm optimistic that we can get out of this in a safe way. And I don't really want the price of gold to go up measured in dollars. If it stays flat, that's fine with me, because that means the world is probably okay. In order for it to triple in price, that means something really bad happens, and that's going to affect people's lives and livelihoods. Yeah. So I don't want that. But anyways, before we go, I just want to remind everyone, we can only make these videos every so often. And if people want to know what's going on in the world, in the banking sector and in the various sectors that will be connected, they can go to that URL that we have. They go to goldsilver.com, click that first link, or you can go in the description of this video, go to a dedicated URL. We'll have all the latest tweets, articles, videos from other people, videos from ourselves, shorts, whatever we have for any bank that might be experiencing a problem, or again, any related sector. So yeah, that's how people can stay on top of it. And thank you, Mike, for putting this all together.
Thank you, Alan. And I want to thank everybody for watching. Please like, subscribe, and click that notification bell. We'll see you next time.